Hey guys, KansasLoanMan here. Today, we're going to talk about what to do if you're not ready to buy a house. You may be ready and you don't know it. There's a few things we're going to cover today. 4 things specifically: money for a down payment. How much do you need? Do you have it? How to increase your income to buy a house effectively, immediately. Also, market conditions. Are they ready for you? Are they where they need to be? And a 4th house hack you're going to want to hear about. These are all things we're covering today to make sure you know if you're ready to buy a house. What to do if you're not ready to buy yet? Well, first off, talk to a loan officer if you're not ready to buy yet. You may be ready and not know it. You may be ready, 100% ready. In fact, I can tell you that saving more for down payment, having money, this kind of things, I can tell you how to have money that you don't even know you have. Help you find it. So talk to a loan officer, someone experienced. I'm an experienced loan officer, and I can be honest and tell you, hey, this is going to work, this isn't going to work. So you know going into it, are you really ready or not to buy a house? You probably are more ready than what you think you are. And that's just the case. That's the truth of the matter. You probably are ready than you think you are. But let's go back into this. Save more for a down payment. I did a reaction where I actually did a video on this about down payment and what it means. When you save for down payment, did you realize that every $1,000 that you put into this saves you $7? Wow. I can almost get a Big Mac with that. I can almost get a couple Whoppers. Okay, I might be able to get 2 Whoppers with that on a buy one, get one day. 1 Whopper, barely. And, I need to get those guys to sponsor this for me, shouting this out to all these millions of viewers and subscribers we're going to have on this channel. The down payment, though, $7. What are you going to do with $7? Not a lot. You can't even go see a movie on $7 anymore. A matinee, can't see a matinee on that. $7 for every 1,000. That's per month, y'all. That's per month on your payment. Oh, $1,000 will do you so much better in a CD. It'll do you so much better in your savings. Do you so much better paying off some debt, because you probably all have a car payment or a credit card or something like that. And unless you're paying 0 to 3% interest on that car, get rid of it. Take that money, do something better with it. Get rid of that thing. It's going to be so much better for you. So saving for a down payment is not a bad thing. However, you have to count the cost of what it does or does not do for you. Every $10,000 you put down saves you $70 a month. $70. That's it. $70. Not even a water payment most months for a family. $70 a month for that 10 G's. When you could pay off a credit card for the same amount and save you $250. Pay that car off, save you $400 for the next 3 years. The power of money and how to make it work for you is what I like to talk about. I'm a complete numbers geek. So the numbers I give you are based on real life stuff, real life figures, real life scenarios, real life calculations with just a basic calculator that we all could use. That's $10,000 saving you $70, bro. I can find something to do with $70 for $10,000 to make more than $70. I can just find something to do with $70 too. Shoot, I'd rather go to a nice dinner once a month on that, which is barely a nice dinner for 2 people, by the way. I'd rather do that than put it on the mortgage. You got the 10 G's in the bank making interest for you. You could probably get 7% a month somehow, somewhere, some way, and go to that same dinner and still have the money in the bank earning interest for you. So think about what money's going to do for you and how that works. Now, that's 20 G's is a savings of $140. $140. 20 G's. Now that will pay off a lot of cars. That'll pay off a lot of debt. 20 G's on credit card debt's $400 to $600, depending on how bad the interest rate really is. So you can create cash flow monthly better than putting it down on a home. So when we run these numbers, personally, I run these numbers as a licensed MLO. Dang, I run those things based on best for this family. What's going to create better cash flow for them? Because the only reason to put more money down on a home typically is to save on the payment or create cash flow monthly so you can afford more of a house, or you can afford the house you want at least. Now this allows you to do that without having to do that. So it makes a big difference here. Increase your income. Yeah, that's going to happen, and it's going to happen over time. So if you're not ready to buy a house because you don't have enough income, yeah, you got to find a way to do that. And interesting enough, I have a program that has not existed until now that if you don't make enough to purchase this home on paper, but you can afford the payment, okay, maybe you've got some extenuating debt, some student loans, something that's keeping you from being ready to buy, and you know it. If you go get yourself a second job in a couple months, I got you, boo. It's a program that is proprietary to me right here in my home state of Kansas. And it's something that I've not really seen anywhere nationwide. I know that my division of my company has proprietary rights in our area to do this program. So there are ways to increase your income immediately to buy. You go anywhere else, you have to have that second job with your first job. 2 years. 2 years. That's a long time. That is a long stinking time. Long time to have to wait to buy a house, and there's really no reason to. So there's experience out there that can tell you that this is possible for you to buy now. Again, you're more ready most of the time than you think you are. I hear this about parenting. You're never ready to be a parent. But once you become a parent, you become more ready than you think. You never know what's going to come around that turn, but you deal with it. You make it happen. You make it work. Buying a house is like a big baby right here. You like birth of that thing. It's going to hurt sometimes. The money shelling out. Woo! That may hurt. Squeeze those butt cheeks, baby. It just might. Increasing your income is a great way to do that. And there's a couple ways that can work if you're working with the right loan officer or the right person that can help you with the right programs. The other thing it says, wait for better market conditions. You see that? Wait for better market conditions. I don't know. Is that really a good thing to do? I'm not so sure it is. I'm not so sure it's a great thing to do. Market conditions, it depends on what the market conditions are. Right now, rates are high. They're just high. If you weren't paying any points on a rate, it could be 7.5%, 8%. Most banks right now, mortgage banks included, have a 1% buy down built into every deal, hidden somewhere, whether on a discount point, which isn't hidden, or within an origination fee they're charging a lot more for, so that they can say that they're not charging you when they really are. So be very careful of that. But market conditions are that. So that keeps your rate in anything from a high 6 to a low 7. And that's not so bad. It's really not so bad. If you look at historically, these are average interest rates right now. They're average interest rates, which is wild because they just come out of the basement dropping out on rates a few years ago, COVID timeframe, to where you could buy a house at a 2-3% deal, which is ridiculous. Should never happen, but it did. So waiting for a better market conditions. While these rates are high, prices are down. They're solidified. They're down. What do you think is going to happen when rates drop and it'd be considered a better market for you? What's going to happen? Those prices are going to go up, way up. So then you're going to be setting on paying on a $400,000 house extra 40 G's for that thing. Rates are low, and that's great. And you think, well, wait, that's going to save me. And actually, it's not. You could have bought the same house for a little bit higher payment, relatively speaking, a little bit higher payment in today's market. And then when that equity swing happens, because rates come down and prices begin to come up and it begins to show up in the marketplace, you refinance on the lower rate. And guess what you just did? You just created your own market. You saved yourself a ton of money for the same house because you bought it when the market conditions not favorable. Chew on that for a minute. Again, talk to an experienced loan officer that knows the numbers, because not all loan officers know numbers. A lot of loan officers are programs people that know the programs. They don't know the numbers. They're not numbers people. They're not numbers geeks. They're just not that way. And I'm a complete numbers geek. Now I look like a geek. Get my glasses on here. I'm a numbers geek. I will run those things backwards, forwards, frontwards, sideways, whatever, 2 or 3 times, and I'll run them with you and simplify it if you're not a numbers or math person, so that you can understand it. And we'll put it on paper and do all of that. If you want to geek out with me a little bit, we can do that. I'll try to make it fun and try to make it in a way that you can understand. So waiting for better market conditions, that's subjective, depending on who you're talking to and what you're doing. Consider shared purchase options. This is not a bad way to go. The last slide on this screen, not a bad way to go if you don't mind living with your family. I know a gal, her family and her are amazing. They are definitely an exception to the rule about how family is. She said, if I had an 8, 9, 10 bedroom house, I'd have my family living with me. Dang, okay. Well, I'm glad y'all are that close. That's amazing. I have no problem with that. I got no problem with that. No problem at all. I'm a single guy, so if I was to get a hold of somebody who was like that, it wouldn't bother me at all. But I better like the family. The family better like me, or there's going to be some issues in that house. Because in my house, you're living in my house. It's one of those things. However, that is an amazing family unit that loves each other, wants to live together. I'm not going to knock that. I may joke about it like I am. Never going to knock that, though, because that's outstanding. A lot of respect for that and that family, that they have that kind of a relationship, that they would be willing to do that. So you can do that if you can stand your family. Other shared purchase options are a duplex or multifamily home. You can do that. And then if you both buy it as your permanent residences, as your I'm living here residences, one live on one side, one family over here, one family over here. You all can communicate through the walls, you know. You all can get a little cup up there and hear what's going on next door. You're right there with each other still. You can save money. You split the mortgage. It will save you money overall. And then when you all want to go your own ways and go out, you may have an investment property you can lease out to make that payment for you. You just have to make sure when you're buying a duplex, though, that you're buying it correctly if you're not overpaying. If you're overpaying, you could have bought a much nicer home for that same payment and not be attached to someone. So be careful on those shared purchase options, because you want to make sure you're getting into the price home for a duplex that cash flows if you ever want to turn it into an investment property, because that is one thing you could do. Buy it, live it in a year or two, turn it into an investment property, cash flow that bad boy to pay for you, and move on to the home that you want to be in with just you and your family when the market conditions are more favorable for you, or you're increasing your job, or whatever might happen. We've kind of already talked about those things and why now may be a great time to buy for the next 2, 3, 4, 5 years, because of the market conditions are putting you in a position to be so much more favorable if you already own a home next year and the year after when rates drop, whenever that might happen. So again, shared purchase options is not a bad way to go. You just have to make sure to calculate the risk of that and what you're doing with it. So that's going to end the comment today on this video. I like seeing what other people are saying about the markets. It allows me to come in and give a real life perspective from someone who is doing the business in the business, has been doing the business, and knows what they're doing in the business. So I hope you all have an amazing day. Reach out to me, KansasLoanMan.com. You can hit me at WillKingMortgage.com if you want to reach out to me there and talk a little bit. All my information is on my channel. Like, share it, and I look forward to talking to you soon. Everyone have an amazing day. Hey, if you enjoyed today's video, you're going to enjoy the next one's coming too. Click here.